discuss whether the U.S. can keep up its strong growth. I'm joined now by Kathy Bostjancic. Kathy is the chief U.S. financial market economist at Oxford Economics. Welcome to the show.
Thank you. My pleasure.
So as we saw, the nearly 7% growth in the fourth quarter, beating analyst expectations. Put that in context for our audience.
Well, overall, strong report. Underneath the detail, not quite as strong as the headline would suggest, but we still had consumer spending rising 3.3%. But what we also had was a really massive rise in inventories, and that inventory build accounted for 4.9 percentage points of the 6.9%. So when you strip out inventories, GDP growth grew 2%. Now that build in inventories normally would be, such a large scale would be very, very negative for future growth, but actually could be a sign that supply chains were easing a bit more than we all thought. Import growth was stronger, and it may mean that we have more goods on the shelves for consumers once we get past this first quarter lull. Certainly Omicron is tamping down on activity in the winter, but beyond that, we look for a spring rebound in economic growth. So this roller coaster kind of in growth continues.
Certainly a roller coaster indeed. So then, which sectors led to the most growth in the U.S. and which ones leave you with the most concern?
Well, in this report, it was actually inventories, and that's counted under investment. And we know that inventory levels are very low, both in the retail and wholesale and even manufacturing sectors. So companies need to replenish inventories, and that lack of inventories, especially in the goods sector, is pushing prices up. So there's a relationship with inflation. So maybe some good news, if we're easing the supply chains, rebuilding inventories, maybe it takes a little bit of edge off of inflation. The other strong point was the consumer, but the handoff, it was noted earlier that December was a little weaker. So the handoff to first quarter softer, and with Omicron, we actually could get a flat to negative reading for GDP in the first quarter before it rebounds later in the year.
So then, obviously, with the U.S. ending 2021 with the best year of growth in 4 decades, is the bounce back just because of how it's being compared to the pandemic, or are the fundamentals of the economy helping?
It's a bit of both. Certainly we had a steep, plunge in GDP growth in 2020. But the rebound, I think it speaks to a couple of things. I think fundamentally, the economy is still solid, but it was certainly helped by really generous fiscal and easy monetary policy. This year, fiscal policy goes from adding and boosting growth to becoming a pretty large drag, and we know the Fed is getting more aggressive, is going to be removing stimulus. So for the economy to stay sturdy, we see over 3% growth. You really need to see labor market and income gains to sustain consumer spending, and also business investment to improve.
And as you mentioned, the Fed dialing back its stimulus, signaling interest rates will go up starting next month, more rate hikes in the pipeline this year. What will that mean for GDP growth?
Well, right now we think that it will temper growth a bit, but it really depends on financial conditions and financial markets, because that's what ultimately these broad financial conditions, which Chairman Powell talks about, that's what really feeds into the economy. Interest rates, even if they lift them 4 times, so say a full 1 percentage point this year, interest rates will still be low. It will still be a little bit over 1%. That in itself is not going to really dramatically curtail economic activity, even with shrinking the balance sheet. What they hope is that financial conditions tighten enough to slow inflation, but not to dramatically slow economic growth.
So then, you mentioned inflation there in terms of some of the headwinds that we know that the U.S. is still going to face. How would you rate the state of the U.S. economy now versus, say, predictions for the end of Q1, given these headwinds for lower growth estimates that we also saw from the IMF?
Well, I think that it's a challenging economic environment. In one sense, overall the labor market's very strong. Income growth should be strong, and that should help keep consumer spending afloat. And if that happens, then businesses will be incentivized to invest. But on the other hand, there's a looming inflation problem. with inflation up above 7% and an unemployment rate below 4%, those are conditions where the Fed has to really start to rein that in. And how they're able to manage that is really going to be important, because higher inflation is also going to weigh on consumer psyche and also business psyche.